For decades, investors have looked up to Warren Buffett for guidance on what to do in different market conditions, and rightly so, as Buffett is one of the few who have outperformed the S&P 500 for decades. The difference in returns is absolutely massive. If someone invested $10,000 in the S&P 500 in 1965, they would now have about $2.4 million. For comparison, if the same $10,000 was invested in Berkshire Hathaway in 1965, you would have made about $355 million. To achieve this kind of return and still make money in market crashes, he constantly makes changes to his portfolio. And there are some interesting things about his trades so far this year. In 2022, Buffett bought a lot more stocks than he sold, making him a net buyer for that year. But this time around, it's totally the opposite, as so far he has sold about $26 billion worth of stock and increased his cash pile to just over $157 billion. We know so much about his trades because of something called a 13F filing. This is a quarterly report which shows all the trades taken by an investment manager who manages more than $100 million. This quarter, Warren Buffett exited his positions in stocks like GM, Procter & Gamble, Johnson & Johnson, and many more. He also noticeably reduced his holdings in HP, Amazon, and Chevron. These trades show how confident he is in certain companies' performance and how much he trusts the others, because about half of his money is invested in Apple, which is by far his biggest position, and that remains unchanged. All these trades won't guarantee him a higher return than the S&P 500. It actually has made a bit less than the market so far this year. These trades are adjustments to his enormous portfolio so that it aligns more with his rules of preparing for a market crash. First, and one of the most important rules, is building liquidity. The point of readjusting your portfolio and maybe selling some stocks is so that we have cash on hand when the market turns. Cash will give you the freedom to make intelligent decisions where others might have to make decisions which are forced on them due to poor market conditions. Cash also gives you the opportunity to hunt for deals. Buffett has made billions investing in companies when they were a good deal, all because he was holding cash when it matters. When investors think of piling up some cash, a lot of them get confused about what to actually do with that money. And there comes Buffett's second rule about avoiding putting all your money into no-growth assets. While talking about the importance of cash, Buffett also emphasizes the importance of equity markets, as cash is great, but doesn't make nearly as much as the equity market. So the secret to following the first two rules is to keep cash as a set percentage of your portfolio. Typically, we should have about 10% of our portfolio in cash and the rest in assets which grow in value. Buffett has a unique breakdown in his portfolio, where the equities add up to $358 billion, and the cash position is just over $157 billion. This means he roughly has a 70-30 split on equities to cash. There is no wrong way of doing this. The important thing is to find the correct balance for you where you have enough cash to survive and invest in a downturn while having enough invested to still keep on growing your portfolio. The way to ensure your portfolio keeps on growing is to follow Buffett's third rule, which is investing in proven companies. As COVID has proven, a company which doesn't have strong business and management fundamentals is very easy to fail. Buffett believes that most major companies will be setting new profit records 5, 10, and 20 years from now. There are various things which Buffett does to analyze a business before investing in them. Things like the company's debt position, companies which have provided good returns on equities, growth in revenue and profit, and comparing them to the competition in that industry are all steps which we can learn from and implement in our portfolios, because the business which you are backing will be the deciding factor on how good or bad you come out of a recession. While researching the stocks, Buffett also follows his next rule very carefully, which is to keep a long-term outlook. Hiccups in the stock market are normal, and some recessions last longer than others, but the market always recovers. When making the decision to buy a stock, he likes to think, what if I am never allowed to sell this? Will I still be invested in this 20, 30, and 40 years from today? Evaluating a business for decades to come will give you peace of mind when the stock takes a temporary dive because you will know how stable the business and leadership team are. To help make the decision, he always follows his last rule, that we should keep the normal game plan. Regardless of what the market is doing on any given day, your goal shouldn't change. By running things as usual, people can avoid a lot of panic when the market crashes and also the fear of missing out when we see a green day. We only get the luxury of following this rule when we have carefully followed the other rules. Not doing your due diligence, not having enough cash, and not investing in strong businesses all lead to people losing a lot of money in a stock market crash. What are your personal rules for surviving a recession? If you enjoyed the video, please like and subscribe. Thanks for watching.